Today, we're jumping right into my portfolio. I want to share with you my companies and why I'm investing in them and my long-term goals as an investor, as someone with a long time ahead of me. And I wanted to share with you the powers of compounding and why I think if you're not invested, you should definitely be invested. But just to give you more stock ideas and how to stay invested in the long term. Now, my portfolio actually took a pretty big hit in just the last week. I've lost probably over $1,000, which to a lot of older investors, that's not that much, but to me, it's like percentage wise of like 10%. So as a college student, it is kind of a lot. But I'm not freaking out because all this money in this portfolio is long term. It's nothing short term. I'm not day trading in and out of these things. And I have a concentrated portfolio. So if I have a company, it means I'm really bullish on them in the long run. I'm going to keep holding on to them. I'm going to explain why that is. Now, something I actually want to point out is this investment calculator here, which kind of shows you my goals. If you start out with $10,000 and you invest for 40 years and you have a rate of 10% yearly and just add $500 a month, your ending amount would be $3 million, and 10% is about the rate of the S&P 500, which is a popular index fund people can invest in. There's ETFs like VU, which I'm personally invested in, and in my Roth IRA, I have mainly funds. But the portfolio I track on this YouTube channel is mainly stocks and that kind of stuff because I think I can get a great return if you just do fundamental research. And I find it fun. It's like a passion of mine, so I like doing that, and I'll show you why. So if we change the percent return year after year to 15% over 40 years, your ending balance actually becomes $14 million, which is a lot more than $3 million. And I really do believe all the companies that I hold right now in the next 5 years can return a rate of 15%. I'm going to describe why later in this video, going company by company. I have more of a concentrated portfolio because I don't want to sacrifice too much diversity from striving away from quality, if that makes sense. But what's so cool about this is over time, you've only invested $240,000 and total interest, so just gains you get from investing, is $13.8 million. I truly believe investing is one of the most passive income things you can do where you can actually make money while you sleep. Because so many people talk about they want to make money while they sleep, they want passive income, and you need your money working for you. And I think investing is probably the easiest hands-off way you can do that. Now, obviously, if you're in individual stocks, you're going to have to research more, but just even being in ETFs is a great thing to do for the long term. And what everyone says when they're older is they wish they started earlier because time is one of the biggest things too, which I'm going to show you right now. If we switch this from 40 years to 30 years, let's just see how much less it would be. Yeah, it's back to 3 million, all because I cut off only 10 years of investing. So if you're someone that's like 20 years old right now, and I imagine I have a lot of young viewers watching this, just get started if it's a small amount because of compound interest, it's gonna make itself up over time, and that total interest is gonna keep accumulating over time just from your small contributions. So timing in the market is more important than timing the market. So now before we start, I think it's a good idea to show how my portfolio has been tracking compared to the S&P 500. And if we look here, you can see that since I've started, which was around March of 2024, that I've been about in line with the S&P 500, just barely outperforming it by 0.5%. I will admit recently my portfolio hasn't been doing great compared to the S&P 500, mainly just due to the sell-offs of Google and Amazon, which are like two largest positions. But I do find these two companies really valuable today, and I'm going to be discussing that later on in this video. Alright, so this little pie right here actually shows what I'm invested in right now. And we're going to work our way up from the bottom to the top in my concentration. And we're going to first start out with Garmin here. Garmin is a company I talked about in another video you can watch, so I'll briefly discuss them. It's only about 2.6% of my portfolio. I truly believe Garmin's actually growing pretty fast. In their last earnings, they actually went up. They report earnings like 20% year over year. Their stock increased like 13% that day, but since all those gains have came back because of the tariff news. But I'm not really worried about that because I think that's just short-term fluctuations. And they grew their earnings by 20%, like I said, which is like more than some of the big tech companies. It's way more than companies like Apple. I think Garmin is really competing with Apple with their wearables. But what makes me particularly excited about Garmin is they have all these revenue segments, and I'm going to show that to you right now. So this chart right here shows Garmin's revenue segments year over year, and each segment is actually growing at a CAGR for the last few years at a really healthy rate. And the one I'm actually particularly interested in is the one in green, but I'll just break down each one by one, and I'll talk about the one in green last. But the red one, you have the outdoor revenue, which is growing 17% year over year on average. And then the purple, you have their marine revenue. They literally work with the Marines, which is growing about 14% year over year. And then you have their aviation revenue, which is growing probably the smallest amount, but still 8%, which is a healthy amount. That's still more than a company like Apple today. And aviation is going to continue to grow. And then in the blue, you have probably what most people think of Garmin, which is their fitness revenue, which is, their watches, why people get their wearables. But it's actually only just a small portion of the revenue. I mean, it is the top portion, but they definitely have other segments. But I really want to hone in on this green part right here, which is their smallest segment, but it is growing. But it's the most exciting because it's growing 30% year over year. It's their auto OEM revenue. And this is just essentially when Garmin works with car manufacturers. So a lot of people don't realize that Garmin actually partners with companies like BU, Toyota, Honda, and they put these devices in the cars that are helping with like GPS monitoring and maps routing, POI searching, and also they're starting to make their wearables be able to unlock cars. And the more partnerships they get with these companies, the more they're going to get a royalty off of that, which is a business model that I really like. And I think Garmin's going to continue to grow 20% every year. I like companies that can grow their earnings per share about 15%. And if we just look at Garmin here, I've highlighted some of the things the OEM industry is working on. And I find all this very interesting for Garmin. I think they're going to continue to grow. And overall, I'm going to continue to hold them. And I think they're fair value right now. Moving on, let me talk about Uber just briefly because I've talked to them about them in the past, but they make up about 3.4% of my portfolio. I think Uber is an incredible company, and they recently went from this transition to where they became a non-profitable company, and now they're becoming more profitable over time. And I think they have so many user bases, and they have this incredible moat, and I just want to dive a little deeper into them. So one thing that particularly stands out to me with Uber is their monthly active platform users, and this is where they're going to gain a big advantage. You can see they're growing this year over year by about 10%, and when they have so many users on their platform, their app, it's going to make other companies like Tesla, Google, and companies where you believe the future of where driving's going and self-driving, they're going to have to partner with someone, and that someone is going to be Uber. Whoever partners with Uber is going to have a massive advantage because they already have 170 million people on their platform. And what I really like about Uber is they're going to capture this market. And even if you think they don't capture the whole market, they still have room to grow. They still can grow their earnings per share 15% year over year, which is definitely something really good to see. You can see here that they're growing their revenue too year over year by a lot. And they're becoming more operating efficient too, so a lot of this revenue is dropping more towards the bottom line, returning to shareholders, which as investors we like to see. And I've had other videos on Uber, but it is a company I'm bullish on, and I did just recently buy more of this company because even though it's been up the most year to date today out of all my companies, I still think it's undervalued, and I still think you can get a pretty nice return on this company year over year. Just real quick, I want to show you a DCF estimate for Uber. Now, I know this might be a little complicated, but I really don't think it is. So I'll try to describe everything using the earnings breakdown. So let's go ahead and look at that. Now, if you think Uber the next 5 years can grow their earnings per share by 15%, and a lot of estimates are actually saying 20% from my research. So this is kind of a conservative estimate, just 15% earnings per share year over year. And then you think their ending PE ratio, which is their price to earning ratio, is 20. And the higher this number is, the more of a premium the company is trading at. And right now they're trading at about 16. So I made these numbers pretty conservative. And even after all that, if you believe that, you're still going to get analyzed returns of 19%, which is really good. And there's room for error too. For a 15% return, you'd have to buy the company at 93, and right now they're trading at 76. So overall, I do think Uber is kind of undervalued right now. Bill Ackman recently bought them, and I'm going to keep adding to them probably. Moving on to my portfolio, we have Intuit, which makes up about 4.5% of my portfolio. And when most people think of Intuit, they think of the TurboTax software, but this company is actually a lot more than that. Similar to Garmin, Intuit's actually growing all their segments of revenue pretty fast, and we're going to just briefly go over each one. The red one here, which is Credit Karma, which is a service that many small business users use. And like I said, they pay a royalty on that. And that's the type of businesses I really like investing in. That's growing 12% year over year. The green is their consumer service revenue, which is things like to provide the consumer services with their taxes and stuff. That's growing on average 10% year over year, which is a healthy amount. The purple here is their global business solutions revenue, which is their globally. That's growing 25% year over year, which is really nice to see. Orange right here is their online service revenue, which is growing 49% year over year, which is good. So all these segments are growing at a healthy rate. And then you have their QuickBooks online accounting, which is growing 26% year over year. Overall, I really like Intuit. I'm going to continue to hold them. I think they're a great company to hold for the long term. And like I said, they have a royalty type business, which is a business I like. And people are just, it's something people are just going to continue to do, right? They're going to keep continuing to do their taxes year after year. And right now, TurboTax is that go-to place. A lot of people kind of spit on it, but an easy business to understand and one that's good to invest in. So I'm going to continue to stay invested into it. Right now, I do think they're about fair value. Next up, which makes about 5% of my portfolio, is we have Adobe. Now, Adobe is that company, Creative Cloud, so think the Photoshop stuff and the Premiere stuff. So they have a massive moat when it comes to that. And what I really like about Adobe is things like colleges. Many colleges around the country are paying heavily for Adobe, and their students are using it to learn. So they have like a kind of like a similar moat to like Office, Microsoft 365, similar Fortune 500 companies use them. Adobe are using colleges, and they're also using Fortune 500 companies too. But what I really like about Adobe is their recurring subscription revenue and their gross profit. You can see here that their total subscriptions are growing around 15% year over year, which is a good sign. And the number one thing I really like about Adobe is their gross profit. Adobe's gross profit is usually around 90% year over year, and that's really good for a company that can generate billions of revenue. And it's definitely a company that can show operating leverage, which is what I look for. I think over time, this is going to compound and outperform the market. It's why I'm invested in them. I'm going to continue to stay invested in them, and I do think they're fair value right now. Moving on at 5.3% of my portfolio, we have S&P Global. And if you're not aware of S&P Global, it's essentially this company that has an indices business and an analytics business. Now, S&P Global did just sell off over 3% the other day, but I'm really not worried about this company. I do think they're pretty undervalued if you just look at their ratios. The 2026 PE ratio is sitting at around 25, and right now they're trading below $500 a share. And I kind of got unlucky with this company. I kind of bought them like right at the peak, right before they sold off. So I am at a loss at them right now, but I'm still really happy to hold this company. You can see in this chart right here, you see their two main revenue drivers right here, which is their ratings business and their indices business. And I have a video on these type of businesses where I discuss this a little more. You can go check out. So I don't want to spend too much time on them, but they're growing both their businesses at a healthy rate. And overall, I'm going to continue to hold them. The next business that I hold is actually MasterCard, and they make up about 7.9% of my portfolio. And I'm a huge lover of MasterCard or Visa. I'll discuss here in a bit why I choose MasterCard or Visa, but this is a great company to hold just for the long term. I recently got asked if my portfolio has any international exposure. I think MasterCard is a good example of an American company that does have international exposure, because there's a misconception that if you just hold American companies, you don't get any international exposure, but that's not really true. In fact, if you look at MasterCard's revenue here in the orange and then in the blue, The orange is actually their international revenue, and the blue is their domestic North American revenue. So you can just see they're actually a bigger company outside of the US, even though they're a US traded company. But I really like this company because they act as a connector to the merchant and the seller and to the customer. And they take a very small fee. And I just like royalty businesses like that because they deal with trillions and trillions of transactions at a time. And they're capturing a small amount of that. It's just a great business model, very predictable company. And overall, I think they're pretty fair value right now. And they've actually been one of my best performing stocks in my portfolio. You can see them here. I'm up about 16% on them. At one point they were up like 23%, but because of the sell-offs, they sold off a little bit because of the tariffs, but I'm not worried. I'm going to continue to hold them, and I'm really excited about this company. Now, why MasterCard and not Visa, you may be wondering? I have no problem with Visa. I think Visa is also a really great company, but one of my most important metrics I actually look at is the return on capital employed. I think it's just a great metric to see if the company you're invested in is actually returning money that's not going back to the shareholders, because any capital they invest in, you're gonna want to make sure they get a return on that, because otherwise that should go to the shareholders either through buybacks or dividends. And in this chart right here, the blue is MasterCard's return on capital employed, and the orange is Visa's return on capital employed. So essentially, MasterCard just has a lot bigger capital employed at usually in the 60%, while Visa's in the 20s. And overall, that's why I'm invested in MasterCard over Visa. Plus, MasterCard's growing a little bit more internationally, which is where I think more of the tangible, addressable market's at this moment. But like I said earlier, I don't think you can go wrong with either one of these companies because they kind of trade it in line with each other. And you can go back years and these two companies just sort of follow each other. Next up at 8.2% of my portfolio, you have Microsoft. And Microsoft's been kind of disappointing for me. They're in the tech category and I've held them for almost a year and I've actually lost money on them. And I'm not really worried about it because this company is such a great company because of the Office 365 products they do. And they're essentially having to force these businesses to use their products. And it's very hard to get out of Microsoft once you're in them with their cloud business and with their Office 365. I just think this company has a very strong moat, and it's definitely a hard company to penetrate their moat. And it's just the type of company I like. And I do think overall they're going to outperform the market in the next 5 years. Otherwise, I wouldn't be invested in them. But you can just look at their metrics right here, how they're growing their revenue year over year. They're continuing to drive up their free cash flow, their EBITDA, their earnings per share are continuing to go up. Their net income, it continues to go up. But yet, if you look at their stock price and you just go back, maybe like 5 years, you could see from like this point here to like here from like 2023 to now, they've just been flat, if not a little down. But yet the fundamentals of this company has not changed. They're continuing to grow at a fast rate. They're going to continue to grow because of the cloud business. And overall, I'm really excited about this company because it's just only a matter of time before they jump up again, kind of similar to what Intuit did earlier. All right, the next company that's in my portfolio that makes up 8.9% is ASML. And I've talked about ASML in past videos, and I kind of want to get this video out. I don't want this video to be too long, but ASML just has a huge monopoly when it comes to these lithographic machines that companies like Tesla, Apple, Nvidia, AMD, these chip-like companies that need the chips, ASML supplies the machines for those big factories, and they hold 98% of the market, which is just impressive. And what's so cool about ASML is their moat is very hard to penetrate. You need to have very smart engineers to actually understand this stuff. So competition-wise, it's going to be hard to break in. So for example, like Domino's Pizza, you may say they have a moat right now if you just look at market share, but another company can easily disrupt that. With ASML, it's going to be very hard for another company to disrupt the advancements in the machines that they're doing. So I really like this company and I'm going to continue to hold them. Next up, also at 8.9% of my portfolio, we have Salesforce, which has gone through a sell-off after their earnings, which weren't great, but they also weren't horrible either. Salesforce, I think, again, is another company with great operating leverage with their business. Salesforce is continuing to grow their revenue on average for the last 2 years, about 10% year over year. If they can just maintain that, because they have such good margins already, you're going to see an incredible business in the next 5 years. Also, just look at this return on capital employed from Salesforce, which is an important metric. Something that investors in 2022 didn't like about Salesforce is the return on capital employed was pretty crap. It was less than 1%, but just look how it's gone up the last 2 years all the way up to 10%, which is a good thing. As investors, we want to see that. And again, I'm investing in this company because I think it will outperform whatever the market does the next 5 years. I'm going to continue to be invested in them because big businesses, even smaller businesses who use them, they need some sort of customer relationship management tool. And Salesforce has a massive moat in that. And they're really trying to scale up Agentforce, which is their AI component. And I think overall, the leadership with Mark Benioff, I think this company is going to continue to grow, and it excites me, and that's why I hold them. Moving on at 11.5% of my portfolio, I actually bought more in this company because I think they're severely undervalued because of speculation, is Google. I'll be doing a DCF on Google here pretty soon just to show you how undervalued I think they are. But if we just look at them here, you can see that all their metrics look great. Their revenue's accelerating. Their revenue by segment we'll take a peek at here in a bit. Their cloud operating margins continue to go up, which is a good sign because that's where a lot of investors see this as a future. And their EBITDA continues to grow. Their earnings per share continues to grow. But yet this company is traded down like 15% year to date today. We'll be discussing why that is. It's mainly because of the Google search business, which if you see in this chart right here, it's that little red bottom part, which is about half the revenue. And people are worried about the LLMs, so AI like ChatGPT and Gronk. They're worrying it's going to take away revenue share for Google search. But I really don't see this as a problem because Google search, most of their revenue is from ads. And when someone looks up like a product, they're going to look it up on a Google search. They're not going to look it up on an AI thing. And that's where the ad revenue comes from. The things people are using AI for, there's no ads for that anyway. So if you were to do like research on something and you were to go to like an AI LL platform rather than Google search, well, Google wasn't even going to make money off of you anyway because they would show no ads to you. Plus, this business has YouTube ads, it has their subscriptions, Google Cloud, which has really, really closed the gap with Microsoft Azure. And I just want to have all three of the cloud businesses. And overall, I really like Google as a long-term investment. So if we do just a quick DCF on here, and if you think their earnings per share growth will grow 14% next 5 years, which again, on average, has been growing over 20%, so that's very conservative. And they have YouTube, they have Google Cloud, they still have their search business. This company has a lot of assets. So 14% earnings per share growth, that's not really asking for a lot for Google. And if they trade at 22 PE, which is really not premium at all, it's still pretty cheap. And right now they're trading at around 21. Then in 5 years, you're going to get on average about 15% year-over-year returns. And if you think this is going to happen, you'd have to buy Google at 171. And right now they're trading at 175. So I think there's a lot of room for growth for Google. And I did add to it when it dropped below like 200, 190, and it just continued to drop. Unfortunately, I ran out of capital to put in this company, but honestly, if I had more money, I'd put more money into Google. But instead, I put it into my number one investment, which is at 13.8%, is Amazon. And this company is, believe it or not, below $200 a share right now, which to me is crazy. Amazon is a company that has everything, and people are worried about these companies because they're spending a lot of money, like billions and billions of dollars on to help with the AI. But I'm going to talk about why I don't see it as an issue and a metric we can look at to help us kind of explain why that isn't an issue. But Amazon, similar to Google, it just has so many segments to their business. It's not just their e-commerce business. They have AWS, which is bigger than Azure Cloud and Google Cloud. So essentially, companies like Netflix, they need to run their platform on something, and they're running it on AWS, and they're paying AWS a fortune to do it. And just a lot of other bigger companies like that need like a cloud service. It's such a great business. you have like the subscription stuff with the Prime, and they're starting to grow their advertising business out too, which still has a lot more room to grow if you compare it to Meta. And this company is going to see no problem trying to grow their earnings per share 15% year over year. It should just be a very easy thing Amazon should be able to do in the next 5 years. So a lot of people are worried about companies like Amazon and Google, and it's why these companies have been selling off lately, because they're spending billions of dollars on this AI stuff. Like Google reported spending $75 billion with a B, and that's a lot of money even for a huge company like Google. And people are just kind of concerned: are they going to get a return on that, or are they not? And personally, I do think they are. And the metric you look at for this is return on invested capital. And if we pull this up right here, you can see that the orange is Google and the blue is Amazon. And year over year, over the last 2 years, both these companies have actually been increasing the return on invested capital. Again, like I mentioned earlier in this video, if a company's going to invest their capital, meaning they're not returning it to the shareholders through buybacks or dividends, they better be getting a return off of that. Otherwise, it's kind of wasted money for the investor. And both of these companies are growing them. In this chart, you can just see at a healthy rate, and 32% for Google and 13% now for Amazon is a good sign that they're going to get a return on this, all this capital they're employing, right? In fact, if you go back to 2022, you may remember Amazon was spending a bunch of money on their capex. It wasn't really going to the free cash flow. Their free cash flow is negative, and their stock dropped a lot because of it. And then ever since then, it's been one of the best returning ones because they've gotten a return on that capital that they employed. And I think it's going to be a very similar situation right now. So that's going to be it for this video. That was my portfolio. Let me know in the comments if you're investing in these companies, what you thought of this video. Hit the like button to get this video out. Comment. It helps with the YouTube algorithm if you didn't know. It only takes you like 2 seconds, and it helps small creators me try to get out. And I didn't really go into depth a lot about these companies. I plan on doing that more in later videos because there's just so many companies to go over, and I didn't want to have this video be such a long one. So that's why I kind of rushed things, but I hope you, and I'll see you in the next one.